Hi there, this is my valuation of BCE Inc. Just as an FYI, this is my personal analysis, so take it with a grain of salt. Before I dive into the company, I'm going to discuss the results of my valuation to provide a clearer understanding of my analysis. So my recommendation is a buy with a target price of $71 that provides a 24% upside from the current price of about $57. This graph here shows how BCE has performed versus the sector and the TSX. Overall, you can see that BCE has performed worse than both of them in the past year, but has been starting to pick up in the past month or so. You could also notice that near the end of the graph, the sector has started to outperform the TSX, and the reason for this is that there has been a lot of volatility and drop in share prices over the past 2 months. So investors have been moving some of their money into less risky assets, which this sector is less risky, but I'll get to that later in the analysis. BCE, or is better known as Bell Canada, is Canada's largest communication services company with a market cap of 51.5 billion. Bell operates in three key segments: wireline, wireless, and media. Wireline is by far the largest segment with about 55% of the revenue. Wireless is next with about 35%, and the media is smallest with about 13.5%. You will notice that this adds up to over 100%, but that is due to intersegment revenue. Looking at the largest segment first, wireline handles the wired aspects of the company. This ranges from satellite TV, fiber optic internet, and landlines. Some of the key news with this segment is the launch of Alt TV about a year ago. Now, Alt TV is a new advancement in the industry which allows people to watch TV on demand without the use of satellite. It also allows consumers to stream TV on different devices. One of BCE's most notable advantages is their fiber optic internet, which has a total fiber footprint of 9.2 million locations. It also has the fastest speed in Canada at 1.5 gigabytes per second. Another project they have announced is their virtual network services platform, which acts as a cloud for businesses. Moving on to wireless. This segment is responsible for handling all the wireless operations in terms of telecommunications. Bell's LTE network reaches 99% of Canadians, which provides the most access in Canada. They also have technology advancements in the industry over other companies. This can be shown through how they were the only Canadian company to support the cellular capabilities of the Apple III watch at launch. They were also the first Canadian provider to enable built-in wireless fidelity hotspots. Now this allows new vehicles to have their own built-in Wi-Fi. They also have a contract with the government to service them with over 200,000 mobile devices. And BCE also launched Lucky Mobile, which provides customers with plans as low as $20 a month. Now moving on to Bell Media. This is the smallest segment and is responsible for handling the media operations of the company. This ranges from TV channels like CTV and TSN to digital billboards. Their TV channels hold some of Canada's top shows, with TSN holding Canada's top sports channel and specialty channel, and CTV having Canada's #1 comedy, drama, and Canadian series. There has been a weakness in the advertising markets, so the segment hasn't been doing too well in the past few years. But to combat this and substitutes, they have launched Crave TV. Crave TV is an online video streaming platform similar to Netflix, but focuses on shows instead of movies. At the end of 2017, they had more than 1.3 million subscribers. In terms of corporate governance, George Koop is the president and CEO and has held this position since 2008. Before this, he has held executive positions within the company and has over 20 years of experience in the industry. Gordon Nixon is the chair of the board and has held this position since 2016. Before this, he was the president and CEO of RBC. There are a total of 13 members on the board, 12 of whom are independent, and the only non-independent board member is the CEO. A notable accomplishment they have received is the Award for Excellence in Corporate Reporting from CPA. For corporate social responsibility, the only thing I want to talk about is Bell Let's Talk initiative. I'm sure most Canadians have heard of this. It's been around for 8 years now and have contributed over $93 million. The purpose of Bell Let's Talk is to try and reduce stigma relating to mental health and to help communities with mental health issues. Looking at the communication services industry, this graph shows how it has performed from 2012 to 2016. Revenue in the industry has had steady growth with a CAGR of 2.7%. This is mostly driven by the growth in wireless, but also comes from non-voice wireline. The areas that have been shrinking are the voice side of wireline. The reason for this is people are moving away from landlines, and in general, talking plans are becoming cheaper. On the broadcasting side, in general, the market has seen weakness. The only real sections that are doing well is the discretionary TV channels and the IPTV. The IPTV is what I talked about earlier with on-demand television, which Bell calls 5 Alt TV. I did a Porter 5 forces for BCE. Their biggest advantage is in the area of new entrants and threat substitutes. Due to the capital intensity and the regulation of the industry, it is highly unlikely a new entrant will emerge. The threat as substitutes advantage isn't as high, as there are a few disruptions in the industry, like companies like Netflix and Skype. They have allowed for some substitutes, but since these companies require the internet, the use of BCE will still be required. Competition and the power suppliers are BCE's weaknesses. This is due to customers generally choosing the cheapest option. This means BCE is a price taker. They also have little influence over the suppliers due to the nature of what they purchase and the competition of the industry. Looking at their financials, revenue has seen a steady growth of just over 3%, totaling $22.5 billion at the end of the last fiscal year. Assets have also seen a steady growth with just over 4.5%, totaling $54 billion at the end of the last fiscal year. Fiscal year end for BC is at December 31st, so they've already finished 3 quarters by the time I did this valuation, and they've actually seen strong growth in these quarters, for the third quarter being one of the strongest third quarters they've ever had. For peers, I have chosen Rogers, Shaw, and TELUS because they are direct competitors to BCE in the sector. The largest advantage Bell has is in terms of profitability. They have an EBITDA margin of 40% compared to 35.5%, a profit margin of 12.5% to 10.8%, and an ROE of 17.1% compared to 16.6%. The other significant advantage they have is in the dividend yield of 5.2% compared to 2.7%, but I'll talk about that a little later on. Wireless revenue is based off of 2 metrics: subscribers and average revenue per user, known as ARPU. Both of these have seen steady growth, with subscribers reaching 9.2 million and ARPU reaching $67.80 at the end of fiscal 2017. For wireline, revenue is separated into 4 different sources: data, local access, long distance, and equipment and other. Wireline has seen good growth, but that has been mainly through the data source, with the other sources remaining relatively stable or slowly shrinking. Now you may ask where this growth is going to come from if Bell is already the largest company in the industry. Looking at the country of Canada, one has to look at the population growth. Canada has had a population growth of just over 1% per year since 2003. By looking at the population, I did a regression between the population growth and subscriber growth. This allowed me to be able to forecast Bell's revenue. For the capital structure, I calculated net debt to be $28 billion for an enterprise value of $79.5 billion. This gives BCE a debt-to-equity ratio of 56%. For the comps model, I used an EV to EBITDA, EV to EBIT, and PE because they produced a good range of metrics to use and were the ones chosen after testing a few other metrics. I adjusted the multiples to account for how BCE has historically traded compared to their peers. This resulted in a final price of $54.50 and a downside of just about 5%. This could suggest that the sector is undervalued due to the bullish expectations of the market. This can also be seen through the graph I showed earlier, that the sector has started to pick up while the TSX has been falling. Moving on to my WACC calculation, I used a bottom-up beta approach and I calculated at 0.58, showing that Bell isn't a very risky company. This resulted in a cost of equity of 5.3%. I got a cost of debt of 4.66%, calculated from the weighted average interest rate of outstanding debt, weighted to the average cost of preferred shares. I decided not to use the yield to maturity because that was a less conservative option. This results in after-tax costs of debt of 3.63% and a WACC of 4.71%. I performed a dividend discount model for Bell and got a price of $82.50 and an upside of 44%. As I said earlier, Bell has a large dividend yield of over 5%. and they have increased the dividends in the past 10 years with a CAGR of 7.5%. You may have noticed that the payout ratio is very high, but management doesn't use earnings as a metric for dividend policy. Their target payout ratio is 65 to 75% of free cash flow. Now, this isn't the same free cash flow I calculate due to theirs being an internal calculation with different metrics. I tried a few different approaches for this model, but after noticing the value I got while using the average rate of inflation over the past 10 years of 1.6%, I realized that this is probably the best option. For my DCF, I used a perpetuity approach and exit multiple approach, both with forecasting earnings 5 years into the future. For my DCF with perpetuity, I got an implied price of 76.70 with an upside of about 34%. And for my exit multiple, I used an exit multiple of 8.4 times, which results in an implied price of 72.40 and an upside of 26%. Now on the left graph, you can see the free cash flow forecast. You'll notice in the first 2 years there is a lot of change, but that is due to how the model works and with the change in net working capital. I did a sensitivity analysis for both. The yellow squares there are 0 to 15% above price, the red is below price, and the green is 15% above price. As you can see, there is a bit of sensitivity, but the changes in WACC and growth are required for the price to drop below the current price. For the exit multiple, there isn't too much sensitivity, with all the sensitivity being on the exit multiple itself, with a sharp drop in exit multiple for it to require to be lower than target price. After weighing these methods, I got a final target price of $71. Thanks for watching.